Chapter 14 Correlation Risk. In this chapter, we are going to look at correlation risk and how a simple model used by hedge funds can help you manage these risks properly. I will go through the process that I used to create my own plan to manage correlation risk. As always, you can follow my process to build your own model to suit your own trading style. What is correlation risk? To put it simply, correlation risk refers to risk of entering into multiple trades that have a common currency. For example, if I enter short on the euro dollar, I am essentially betting on the euro to weaken against USD, or the USD to strengthen against the euro, or both of the above. It is very important to realize that any of these possible outcomes will be in favor of my trade. I don't know which one, and I cannot control what would happen. A second trade comes up, and this time I am short the euro Japanese yen. This means that I am betting on the euro to weaken against the yen, or the yen to strengthen against the euro, or both of the above. Looking closely at these two trades, I can see that out of the 4 possible outcomes, 2 of them are bets on the euro becoming weaker against the other currency in the pair. So, if the euro gets stronger, then there is a risk that both of my trades could be unsuccessful. To put it simply, both of my trades are exposed to euro strength. This is the basic definition of correlation risk. I believe that most new traders look at correlation risk in a very biased way. They only attribute correlations to losing trades. They blame correlations for losses. They don't recognize the fact that correlations can also contribute to winning trades. Imagine if you are short the Aussie yen, Euro yen, and the pound yen at the same time. Without even doing any math, you can tell that these 3 trades are somewhat correlated because of the yen. You can win all 3 trades if the yen strengthens against other currencies. When was the last time you hear a trader complain about correlations when their trades were winners? The answer is never. No one cares about correlations when they win. They only bring in correlations for losses. This is a psychological condition called confirmation bias. Banks and hedge funds have teams of people dedicated to correlation risk. These are exceptionally intelligent people with access to a lot of resources to monitor correlations across all of their positions in the market. Retail traders like you and I cannot do this on our own. Yet, some traders use correlation data published by brokers as part of their decision-making process. They get sucked into the pretty colors and flashy numbers without ever questioning whether they have the capacity to even understand what is going on. Here's a question that I want you to consider. Are you willing to make a trading decision based on something that you don't fully understand? Let's go back to my example earlier, but this time imagine that you are the one taking the trades. You have already entered short Euro USD, and now you see a short setup on the Euro Japanese yen, which meets all of your entry criteria. Realizing that your trades could be exposed to correlation risk, you quickly look up correlation on your broker's website. This is what you see. Which number do you use to make your decisions? How do you know that these numbers are correct? What would you do when these numbers change after you are in the trade? As you can see, the idea of using correlation numbers published by brokers as part of your decision-making process creates more uncertainty than it is worth. Instead, we should look at how banks and hedge funds manage exposure. We don't know what their internal process on correlation risk is, but we can see its final results. I attempted to reverse engineer their process, and I have come up with something that is simple to understand and makes sense to me. This is how I did it. I noticed that hedge funds always publish their portfolio exposure in their performance reports. These reports are intended for potential customers, and by law, they have to be correct. Otherwise, the fund is at risk of false advertising. They could lose it all if they publish funny numbers. Here is an example of what I saw. This table shows that the fund is 10% exposed to metals. This means that if they were to lose out on all of their positions in the metals market overnight, it would result in a 10% loss. I don't know what the individual positions are and how much they correlate with each other, but I can see the final result. I took this concept and applied it to Forex. Instead of markets, such as metals, I create a market for each currency. After going through all the pairs that I trade, this is a list of the currencies that I could be exposed to. Next, I set my own limit on how much exposure I want to have in each currency. This was just an estimate based on the position size that I was trading at the time. Currently, my exposure limit per currency is 2% based on a capital risk per trade of 0.25 to 0.5%. Whenever I'm in multiple trades at the same time, I always make sure that I don't go over the limit on each currency. Let's take a look at an example to see how my model works. Example 1. You set yourself an exposure limit of 5% on each currency. You are taking 2% risk on each trade. One Tuesday morning you entered long Aussie USD, and in the afternoon of the same day you entered long Euro USD. This is the individual currency exposure so far for these two trades. Let me explain how this table works. Your 2% long position on Aussie USD is recorded as 2% exposure on the Aussie and 2% exposure on USD. Same with Euro USD, 2% exposure each on the Euro and USD. At this point, I know that some of you would say that these numbers are incorrect. The numbers add up to 8%, but there is only 4% at risk. Shouldn't it be like this? Here's the reason why the numbers are doubled of what most people would think. If you risk 2% on Aussie USD long, then that entire 2% is exposed to movement in both the Australian dollar and the US dollar. You cannot assume that the risk is split evenly, 1% in Australian dollar and 1% in US dollar. The entire 2% can be lost even if only one of the currency moves against your analysis. Back to our example. Now you are long Aussie USD and Euro USD. Both trades are still open when you see a setup to go long on the Pound USD. If you enter long with another 2%, then your total exposure to USD would be 6%. This is over your set limit of 5%. At this point, you have two options. Option number 1. Take the trade with 1% risk instead of your usual 2%. Option number 2. You don't take the trade at all. This is your exposure if you decided to go ahead with the trade but using half of your standard risk. As you can see, using a 1% position size, you would be able to keep your exposure to USD at your set limit of 5%. The logic behind my process is to allow the trader to take correlated trades but within a certain limit. I don't look at correlations in a positive or negative way. I simply look at it as a risk to manage. If I take too many trades that are correlated, then I am more exposed. At the same time, I don't want to skip trades simply because it correlates to other trades that I am currently in. I build my process based on minimizing exposure in the event that all of my trades are losses. But I also allow myself a chance to win by taking these correlated trades. It produces consistent results because it only allows two options. Take the trade with reduced risk or skip it altogether. I don't even need to know the correlation numbers between the pairs that I trade. My decision-making process only involves the things that I have complete control over. It is the choice between reducing position size to lower risk or skip the trade altogether. Both choices are mine to make. Here is another common example that traders encounter: going long and short the same currency in different pairs. Example number 2. You have a 5% exposure limit on each currency. Your standard position size is 2% per trade. You are currently in 2 trades, Australian Japanese yen long and USD Japanese yen long. You spot a potential short trade on the Aussie USD, but you are worried that you will be long and short AUD and USD at the same time. Let's see what happens when you include AUD short with 2% risk. Despite the feeling that you are trading against yourself, your exposure limit of 5% per currency has not been hit. I chose this example because I want to point out something very important. Exposure does not involve the direction that you are trading. Some might argue that going long Aussie Japanese yen and short Aussie USD would give you zero exposure on the Australian dollar because they are in different direction. This way of thinking is flawed because it makes risky assumptions that I have already discussed earlier. My exposure model measures the risk associated in a currency regardless of which way it moves. I don't know which way the market will move, so I cannot let the direction of the move be a factor in my decision making. I have created a brand new calculator to help you work out your exposure as fast as possible. Here are the instructions on how to use it. Step 1. Set your maximum exposure. This is a personal choice and will differ from one trader to another. The strategy that you trade can impact this number. Speaking from my own experience, I have never been in more than 4 reversal trades at the same time in the last 3 years, but my trend following system often have 12 open trades at the same time. If you have done at least 100 trades, then you can look back at your trading history to see the maximum number of trades that you were in simultaneously. Multiply that number by your typical risk per trade and you have your answer. In my case, I did 4 times 0.5%, which equals 2%. So my exposure limit per currency is set to 2%. If you are new to trading or don't have stats on your trading history, then pick a conservative number to use for now. As you gain more real trading history, you will be able to use the suggestion above. Please note that this is only a suggestion. You can set whatever limit you think is reasonable for you. I always recommend using actual data to make decisions, but you are free to use whatever method you think would give best results. Step 2. Fill in the trades that you are already in. Step 3. Fill in the trade that you are thinking of entering. The calculator will let you know if you are going to exceed your exposure limit or not. This is how I manage correlation risk, not by looking at the correlation numbers between the currency pairs on a specific time frame, but by putting a limit on how much exposure my account can have on correlated trades. It's a simple model based on what banks and hedge funds use. It does not require any calculation of correlation between the currency pairs. Most importantly, it removes emotional biases because it does not favor any particular currency over the others, and it is not influenced by the direction of the trade.